I'm still in Paul's camp. All along, it's been December. And, I think the major reason why, it's something we don't talk about, is that Yellen has continually said that they look towards raising the rates. It's interesting as you look at asset classes behind me, especially Fed futures, they're pricing in March or June of next year to be the first hike. But I still think that it's not about the macro data as much. It's more to the extent that they are weary of having these emergency monetary measures in place, and they are fixed on raising rates. I don't listen to the noise. I do believe it's going to be December.
It's going to be December. And do you think that there's any chance that once we see that move in December, that after that we'll see them retrace their steps and lower it again, or any kind of QE? Or do you think this is well and truly the start of rates going higher and more of a recovery in the United States?
Wow, that's a good question. I think that message is going to have to come before it actually happens. I mean, I think the next meeting that we see, Yellen's going to have to get towards normalization and get the market straight, because the market definitely is not pricing in a December rate hike. But again, it's not, I mean, the macro data clearly needs to be 150,000 job ads. It needs to be a 2% GDP, et cetera, et cetera. But all that to say, it's more about the fact that these emergency measures need to end. And I do believe there'll be more turbulence and volatility in the market like we've seen before, but it's something that just needs to be, and our data is good enough for that to happen.
Paul, we've never seen a major economy like the United States wind back a program like quantitative easing at these kind of levels. We've got UBS out with a note today suggesting that the Aussie could hit 80 US cents if Janet Yellen chooses QE over a rate hike. Do you think that's still a possibility?
Well, certainly. I mean, the data have weakened a bit recently, and that's what's made the market run in that direction. But as we've said, we Larry agrees that we think that, HSBC thinks that they'll be lifting rates before the end of the year. We think they'll be on a very slow path to lifting rates. That rates will be, the Fed funds rate will be 1% by the end of next year is what we've got in mind. Now, that works against the note you've mentioned. It suggests that there's probably a bit more downside to the Aussie dollar, if anything. But sure, if the US economy were to weaken, if that view were to be wrong and the US were to go in the other direction, then there would be potential upside to the Aussie dollar.
Larry, why do you think there's such a divergence between what markets are expecting the Fed funds rate and what we're hearing from the chair of the US Federal Reserve, Janet Yellen, who's telling us to expect a move this year?
Yeah, it's a great question but I think not too long ago, the RBA surprised, and there was an 80% chance, 80% of the people got it wrong. So perhaps that can happen. Consensus can indeed be wrong, and they've been wrong before. Very interesting question. I think people are reading through the data, and this rally that we've seen in the equity market, this 9% rally, is positioning and pain. People just grasping for anything. But it's very peculiar question, or there's just really no good answer, except that people continue to think that the data needs to be much better than it is for the FOMC to finally hike those rates, and that we had two commissioners last week get a little bit more dovish than people thought they previously were, adding fuel to that fire.
Yeah, Larry, it kind of feels, sorry, Paul, that it's self-fulfilling in that the market says, we don't think it's going to happen, we don't think it's going to happen, and then because we don't think it's going to happen, you shouldn't do it because we're not ready for it now. It's quite a crazy situation. Do you think that the Fed will be paying attention to that and say, because the market isn't ready, we're not going to move, or do you think they won't worry, they'll just focus on the data?
I don't think the Fed's paying a whole lot of attention to that. I mean, I think the market itself thinks they are looking at them, but no, I don't think so. We have to remember, this is a policy experiment that's never been attempted before. We have absolutely zero idea how this all is going to turn out. This is an emergency situation, 7 years of zero interest rates. Our data is good enough for this to happen. I really don't think that Yellen and the FOMC is looking at consensus and is going to dictate, or that's going to dictate their policy action.
Larry, the inflation numbers are very low at the moment. On a year-on-year basis in particular, they're flat or negative at the moment. And do you think to some degree that year-on-year number that's still got the 50% fall in oil prices that happened at the second half of last year is part of the reason why markets are thinking, well, actually, there's no inflation? And when we get to January, when these year-on-year falls start to fall out, that sticker shock might start to disappear?
Yeah, Paul, that's a good point. Also, look at some of the other measures of inflation, especially the core numbers. Those numbers are much healthier than the market gives it credit for. I think inflation is something that people are underestimating how quickly that can rebound back. And precisely, oil prices definitely have a huge impact on the headline numbers that we see. But the numbers below the surface are indeed showing that there is inflation on the core level and also with wages. So that to say, I do think we're going to see this hike just like you do in December.